Welcome, everyone. If you are here to improve your cash position with the 7 simple key financial levers, and you're in the right place. My name is Warren Sager, and I am one of the business coaches at Assured Strategy. Assured Strategy is a business coaching firm based in Texas, and we have coaches supporting us all around the United States. And we're all excited to be able to support the business community and help business leaders learn and grow. I want to let everyone know that this video is being recorded, and we'll be able to share it with you guys later. So we have a YouTube channel for Assured Strategy where all of these webinars are being held, and you'll have access to see that once we get it posted up there. So take notes, but also you can just listen knowing that you have access to it after. And I also want to say that this is an interactive webinar. So as much as I love to speak, I want to hear from everyone else too. So if you have a burning question or want some clarification, please go ahead and put that in the chat. And Via Lane, who works with me in our home office, is monitoring that so we can make sure we answer questions and get everyone up to speed. So having said all that, let's get going. I am a scaling up coach, which means that I'm certified in the scaling up methodology of helping businesses grow and scale. And these are the two books that are the foundational books that scaling up is based off of. And this part of what we're going to talk about today comes from the scaling up book. There's some really great tools and information in here. So a really good resource to look at later. And in scaling up, there are basically 4 components to scaling up a business for growth: people, strategy, execution, and cash. And we spend a lot of time working with our clients on all 4 of these decisions and disciplines and the work around helping them grow. But today we're going to focus on cash, because cash is the lifeblood of an organization and is so important to making your business grow and being healthy. So I'm going to dive right in with this simple triangle to show you the importance of why cash is so important. So down here at the bottom, we have liquidity. Liquidity is cash. It's the money you have to pay your bills, take money for yourself, and support the growth of your organization. So as you see, liquidity is here at the bottom. This is the foundation of what you build everything off of. Liquidity, cash. The cash supports the growth. You need money to be able to grow your business. Money supports the growth. But growth in itself is not everything. You need to have healthy, profitable growth that leads to profitability. Profitability should bring cash to create liquidity. And what you're hoping for is this nice circle of growth. Healthy growth creates profits, creates the cash liquidity, investing in growth. And this is how you scale and build a company. If you are missing some of the growth, or if you're not making the profit, you won't have the liquidity. When you don't have the liquidity, things start to change. And so this is really important. Today, we're going to focus on how to have profitability and liquidity, not just growth. So I want to stop sharing for a minute, because this is the moment in time when I want to share a story. This webinar is one of my favorites because I created this webinar from a personal experience. I am a business coach now, but for the past 30 years or so, I've been an entrepreneur. I built, scaled, and sold 7 different companies over my career, and done really well, made a lot of mistakes. And today I want to share with you my first company, the biggest mistake that I made, which actually cost me the company. So I'll get to the punchline first. My first company, I was 25 years old and was really excited about having my first business. It was an existing business that I bought from a gentleman who wanted to retire, and it was a company called Mattress Makers. Mattress Makers was a factory direct mattress company. We made mattresses in our factory and sold them in our own factory direct retail stores. We only had 2. We were not a huge company. Anyway, I was really excited and motivated, and I wanted to build a great business. And so what did I do? I focused on what I thought was the most important thing: growth. I wanted increased revenue. I wanted to build a big business. And guess what? I actually did that. Each year, I kept growing the revenue, increasing sales, and we were doing really well. But you know what I didn't think about or understand is this whole idea of what I was explaining, which is profitability and the liquidity to support that growth. A mattress factory needed raw materials to build the mattresses. And of course, when people wanted a mattress, they didn't want pieces of a mattress. They actually wanted a actually built mattress. So I had to actually have mattresses already built on the shelf, ready to go and be delivered. And so the more I sold, the more raw materials I needed. The more I sold, the more finished mattresses I needed. And what was happening was I was selling more and more, and I needed more inventory to support those sales, which required cash. But I didn't have the cash, and I didn't quite understand what was happening. All I knew was I needed just to bring in more revenue. And so my focus was selling, 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 and I did. Because I didn't understand what I'm going to teach you guys today. And fast forward to the end, my last year in business was our record year in sales, record year. And I went out of business because I ran out of money. Now, there was another factor, which I will share with you just for a second, because I think it's pertinent, is that I also focused, my whole strategy was on operational effectiveness, meaning just working harder, running a smart business, making things tight. Operational effectiveness is not a strategy for growth. So I'm a strategy coach, and we work with our clients on how to make sure they're working the right strategy. But I didn't know that at the time. So I worked on being efficient, and that was not a reason for successful growth. But the main thing is I ran out of money and I lost my business. And that lesson was hard learned. And luckily, it was a long time ago and I've recovered from it. But again, today, I'm going to share with you a lot of the things that I didn't know. And I hope, if at all possible, if anyone is facing some of the challenges that I was facing, that the things you're going to learn with the 7 levers and some cash flow management will really help you with your business. Okay, I'm going to go back to sharing my screen and back to my presentation. All right, so again, remember, here we were, growth, profitable, healthy growth leads to liquidity, leads to growth, profitability. So there's a mantra now that I say a lot, and I want you to say it after I say it because it's that important. Revenue is for vanity. Profitability is sanity, but cash is king. Revenue is vanity. Profitability is sanity. Cash is king. I've gone to a lot of networking events for entrepreneurs, and all they talk about is, oh man, how big is your business? And you talk about, well, I did 10 million, I'm at 5 million, I grew $2 million this year. Who cares? What we really should be asking or talking about is, how much money do you have in the bank? Because that's really what matters. But of course, keep in mind, we don't talk about money with people. That's just, impolite. But what really matters is money. So I want you to be thinking about that in your business, that you really need to have the money. Now, the other thing I'll share with you here is this whole idea of then, where do you learn about money? Well, that would be your cash flow statement. We talk about financials in business. And when you say, let's share our financial statements, those are usually 3 pieces of documents. Document number 1 is your P&L, your profit and loss statement. Profit and loss statement. Your second one is your balance sheet. And then the third one is your cash flow statement. Now, I know from personal experience for me, I focused on one and only one document, P&L, profit and loss, and more on the top line, which is the revenue side, which I explained to you. So the P&L shows you your profit and loss, revenues, cost of goods, expenses, and then profit. But even that's just on paper. If you show a healthy profit on paper, does it mean you have money in the bank? No, it does not. So that one document alone does not tell the full story. If you want to run a healthy growth business, you cannot focus on just your P&L. You have to focus on also the balance sheet. What's on the balance sheet? Those are your assets and liabilities. And the main ones, of course, are your receivables, payables, inventory, and all those things, like I explained in my story, affect the cash. And even if on paper you're making a lot of money, doesn't mean you have money in the bank and you're not healthy. So P&L and balance sheet, and then cash flow statement. What does that mean? It's a document that helps you foresee the future of what's coming up for your cash needs to make sure you have the cash. So many businesses don't even have a cash flow statement. They wouldn't even know where to begin. How do they manage their cash? Oh, it's real simple. All they do is every day they open up their computer, look at their bank account, and see how much money is there. That is a recipe for disaster. You have no idea what's going to happen next week or next month just looking at your bank account today. But a cash flow statement that is looking at your forecast for receivables, payables, inventory that your needs are going to be, predictions for revenue, all those things are factored in, and therefore you can predict the future on cash and know if you're going to run short. Because what's important, cash is king. You need to know how much cash you're going to have. So want to reiterate 3 documents as a business owner to be looking at: P&L, balance sheet, and cash flow statement. Work on all 3. If you don't know how to do it, that's fine. There are a lot of professionals out there that can help you. Your CPA should be able to help you. A good bookkeeper possibly has had experience in some of those things and can help you, but there are resources and you really need to reach out. If you're not doing that, then you're really not looking at the full picture of cash. But that, again, that's just reporting, right? That's just, once you see those numbers, it's what's already being done and what's happening. I actually want to talk to you today about what you can do to impact your cash. And that's hopefully why you're here, because you're like, hey, I'd like to have more cash in the bank. What do I need to do? So now I'm going to share with you a couple of tools that you can use that will really help you think about cash and how to improve it. So the first tool we're going to look at here is the Cash Acceleration Cycle tool. So you've heard the old saying, you need to spend money to make money. Yeah, it's pretty true. But what they don't tell you, and what we really need to focus on with this tool, is the key is when you spend money, how quickly can the dollar you spent come back into the business? And the reality is you want it to come back as quickly as possible. The longer it takes for that dollar to come back, the more dollars you need to support the business, and cash is king. So you want to spend as little cash as possible and keep as much cash. So really important to think about that cash. So how do we do that? The cash cycle, there's 4 components to it. A, B, C, D. We try to keep things simple. So the first part of the cycle is the sales cycle. From the moment you start talking to a customer till you make the sale, how long is that? And of course, least amount of time is better. Now, of course, every business is different. Some businesses, just by nature, the sales cycle might be 1 or 2 years if you're working with some big enterprise system or working with a customer base, let's say like the government or something, where there's a long lag between making decisions. So some of that you can't control, but some of it you can. But the sales cycle obviously affects your overall cash cycle, because once you start the sales cycle, you're spending money on salespeople or your own time and energy or samples or creating marketing material. All those are costs, money out of your pocket to start the process to make sales. So then B, the second part of the sales cycle, is your inventory, making it, producing it. If you're a service business, providing the goods and services, or getting ready to provide the goods and services to your customers or clients. And you could see, though, that B is overlapping A and C. And of course, C is the delivery cycle, because in some businesses, you start making the thing before you sell it. I did in my mattress business. I started making mattresses before I sold them. So I was making them before I started the sales cycle, before somebody walked in my doors to want to buy. Other people maybe wait until the actual sale is made and then you start producing. But there's variations there. But A, B, and C is from sales all the way to delivery. And the goal is to figure out how to shorten that cycle. So D is the more one that's black and white, that so many people really understand and know. And that is the billing and payment cycle. That one's pretty black and white. From the time you send the bill till you actually get the money in the bank. And there are a lot of business owners that focus on this one. And that's great. You need to. But the others are sometimes more important, because they could impact the cash and that cycle even further. So the goal here is to reduce the amount of time it takes from the dollar to get spent to the dollar to come back through the cash acceleration cycle. So let's dig a little deeper about what this means and what you could really do. First thing I want to mention is this tool is not for you as the owner. You probably have ideas and thoughts, but where this tool really comes to life is in the entire team. The folks that are out there on the front lines delivering your products or services or working with your customers or producing the goods, those folks know where all the dead bodies are. They understand your business because they're the ones living it. So you want to bring everyone into the conversation to discuss this. And there are so many stories where I've seen firsthand companies that are not doing something that needs to get done, or there's something not working right. And finally, they find out the answer because the guy on the factory floor, somebody went to him and said, why are you doing that? He was, oh, well, thank you for asking. No one's asked me before. Actually, we should be doing it this way because it would save so much time. Well, duh, but nobody asked him. So this tool is a team tool, and you should really bring in the different teams and ask questions. Those questions will give you the answers you're looking for. You can't sit down with you or your leaders and answer all of this. The power of this is in the team. So improve the sales cycle. Well, everyone that's involved in the sales cycle, let's look at what ways we can shorten that cycle. And there's three main ways we can look at shortening all of these different cycles. One is shorten the time itself. Hey, it takes us from the time we normally talk to customers to close a deal, let's say is 60 days. How do we shorten that? Let's have a conversation and look at all the things that happen and what we do and what ways we can shorten that cycle. So that's pretty straightforward. Number two is a huge one, eliminate mistakes. In what ways are we actually making that cycle time longer? Are we creating mistakes that take time? So for example, if you promise someone that you would deliver a proposal and it's due on Friday and you give it to them on Friday and there's some things in it that you missed because you didn't quite listen carefully to what they were asking for, they say, well, this wasn't in there and that wasn't in there. And you're like, oh, sure, no problem. I'll get back to you and we'll get together next week. Well, guess what? You cost yourself a week because you made a mistake and didn't hear and get everything in it the first time. So eliminating mistakes. And then this third part here is improving the business model, P&L, meaning holistically look at not just tightening up what you're doing, but can you do it in a completely different way? Just because this is how you've always done it is not necessarily the best way to do it going forward. And I've seen this so many times when we coach clients, is that businesses are growing and evolving just like we do when we're younger. What worked for us today does not work for us tomorrow, or what worked for us yesterday is not going to work for us in the future. And even though it got us here, it's not going to get us where we want to go. So we constantly got to look at how we're doing things, and maybe we need to change the way we're doing them holistically to get a better result, to shorten this cash acceleration cycle and get those dollars back in the business faster. So you want to do that with your sales cycle. You want to do that with your production cycle. You want to do that with your delivery cycle. And then you also want to do that with your billing and payment cycle. And definitely make sure you get all the right people involved at those different levels that are living it and breathing it, and ask them, hey, how can we make these things better? And why should they care, by the way? You need to the why behind everything that you do. We teach our clients this all the time. The why is so important. Why would the guy on the factory floor care that he was able to give you a suggestion that shortened the time it took to get it done, that maybe put a few more dollars in the pocket of the company, in you as the owner? Well, the answer for why usually is then they wouldn't care. But give them the why. You need to explain to them that a healthy business that has cash is able to grow. Growth means more opportunity for the team. Growth means raises. Growth could mean bonuses. Growth can mean more other benefits and things to help the team. So you've got to explain to them the why to get them motivated to want to participate in these exercises, participate in having a great conversation about how to improve the cash acceleration cycle and put more money in the bank. All right, let me pause for half a second, take a drink of water, and check and see if we got any burning questions that have come through yet. All right, we do not, so that's great. I'm going to keep going. So the cash acceleration tool is a great way for the entire team to work on tightening up the business and make more cash show up in the business. But this whole webinar is about the 7 levers. So let's talk about what those 7 levers are. This is another tool called the Power of One. Now, this tool is now more geared for the owner, the CEO, maybe the leadership team. This isn't for everyone. But what most leaders don't realize is that there are certain things that you have real control over that have a tremendous impact on the business, the profitability and the cash of the business. And so we're going to go through what those are and how you can impact. And so, not going to hide them. Look, they're right here. These are the 7 levers that we're going to go through. Price increase, volume increase, cost of goods reduction, overhead reduction, reducing in debtor days, which is reducing your receivables, reduction in stock days, which is inventory turns, and then increase in creditor days, which are payables. These are all the levers that a company has at their disposal to impact their profitability and cash. So let's look at what they are and what they mean. Price increase. Well, that's pretty simple, raising your prices. Now, we're all probably very aware of this lately in the past few years with the inflationary factors going on in the United States. There have been a lot of price increases. And why is that happening? Well, their costs are going up, and so they're raising their pricing to offset their cost increase, which is making sure that there is a healthy profit. It's important. You have to make enough money to actually make a living and support your business to keep it healthy. And most people don't think about that enough. Now, keep in mind, you want to raise your prices. Hey, can you raise your prices 100% and double your profit? Conceivably, but no, because like with anything, there's always a consequence for every decision you make. So why this is called the power of one, because sometimes incremental changes actually are more powerful than you realize. Rate of change. If you put a 1 in here, and we're going to look at an example in a minute, but if you put a 1 in here and you raise your price by 1%, what would happen? Well, I could argue that your prices would go up 1%, which means your revenue would go up 1%. It probably would have little to no impact on your customers. They would be like, okay. And you would then, that $1 would increase in your revenue. It would increase your profit, and that dollar would go right to the bottom line because nothing else changes other than you raise your price. Well, that would be pretty cool. Why wouldn't you do that? Okay, that's 1%. What if you did 2, 3, 4? I don't know. Now, at some point, your customer is going to notice or get affected, and you'll start affecting your customers, and they will maybe not do business with you anymore. So that is the consequence of raising prices. But wouldn't it be interesting to see what happens? So here, let me share with you another story. This was one of my other companies that was way more successful, and we decided we needed to see how much we could impact pricing. I'd learned my lesson. I had actually been scaling up a customer, and so I understood the power of one and raising my prices. So see, I'm learning and growing as an entrepreneur and using this stuff. So we decided to raise our prices 1% a month and watched our overall customer conversion rate for sales. And after the 5th month, we went up 5% and we started to see a drop in conversion immediately. But until then, there was none. So what did we do? We up 1% 1 month. The second month was 2, no change. We made 2% more margin. Third month, 3, no change. We increased our margin 3%, more profit, more cash. 4%, great, no issues. 5%, that's when we hit the wall. We immediately lowered it back down to 4% and left it there. We now increased our prices by 4%, increased our our gross margin by 4%, and increased our profit by 4%. Nothing changed. So that's an exercise you should really think about, is raising prices. And when was the last time you raised prices? But again, keep in mind, price increases do affect your customer, and your customer is important. So you really need to think about your customer. Okay, so price increase, that was number 1. Number 2 is volume increase, increasing your volume. Now, this is what I did in my mattress business. I increased volume. I sold more. But of course, as I explained to you earlier, when you sell more, you're going to increase your revenue because you're going to sell more. But there's more cost associated with that. More cost to produce the goods, more cost in overhead, and overall strain on your business. So yeah, if you had a choice between increasing revenue or increasing profit, one for one, you probably want to increase profit because it doesn't affect anything else as long as it doesn't affect your customer, where volume has, other implications as you're increasing volume every step of the way. And again, we're going to look at an example in a minute to show you a little of what that means. So the next one is cost of goods reduction. So just like price increase, for every % of cost of goods expense you save, that goes directly to the bottom line. The cool thing about cost of goods reduction is it doesn't impact the customer. It just impacts you in a positive way. So it'd be great if you could figure out how to reduce cost of goods. Now, how do you do that? Well, if you work with a lot of vendor partners that supply you things, you can go to them and ask them for a discount. Ask them for some volume discount for buying more. Now, of course, that would affect your inventory. So remember, everything we're doing here, every decision you make has implications and consequences. If you raise your cost of goods, if you lower your cost of goods by buying more to get a discount, but what does that do? It'll increase your inventory. So that'll affect the thing down here. So again, but you could play with these numbers. That's what's great about this exercise is you're going to play with numbers and it's not going to affect business because you're just going to play with the numbers. And once you come up with a strategy on these that you like, then you could put them into practice and implement them into your business. But in the beginning, this is could be just a theoretical exercise with your team or with yourself on a piece of paper, on a spreadsheet, on a whiteboard. Hey, what if? What if we raise prices? What would happen? Oh, maybe nothing. Well, hey, if we raise prices 20%, what would happen? How many customers would we lose? Oh, we'd lose maybe 10%. Well, cool. Maybe that's not a horrible thing. What would that look like? Let's run the numbers. And that's what this whole thing is about. So back to our cost of goods reduction. So now you're reducing your cost of goods cost. For every percent you do it, even 1%, 2% goes right to the bottom line. Hugely impactful to your cash flow and your profitability. So how do you do that? Like I said, you can get with your vendors. You could go back to that cash conversion cycle. The folks that are responsible for creating the cost of goods, whoever they are, how do we make it tighter? How do we save costs? So have that conversation, ask those questions. So I want to point out that these top 4, pricing, volume, cost of goods, and overhead, all that affects your P&L, your profit and loss statement. Those are all going to impact your profit and loss statement. The last 3, payables, receivables, and inventory, those are going to impact your balance sheet. And so that's why you've got to look at both of those documents because both of them are impacted by these different levers. Okay, so debtor days. Again, that is your receivables. You want to get paid and you need to have less money owed to you. You want it in your bank, not in theirs. And that goes back to the cash conversion cycle on billing and getting payments. You want to get paid sooner so the money's in your bank account. The less amount of receivables you have, the more money you have. So how can you reduce it? Most accounting softwares allow you to look at the average days that you have in receivables. And the goal is, okay, let's say we have net 30, which means, we invoice and we get paid 30 days later. What is our average days of receivables? Well, hopefully if you're doing net 30, it is 30. What typically happens is if it's 30, it's not 30 because people are not paying on time, and maybe it's 40. So maybe the first goal is to get that down to 30. Well, how would you do that? Well, there are lots of ways you can do it. One is you could send them out earlier. If you're sending it out at day 20, hoping to get paid in 10 days, because you've only now given them 10 days to pay from 30, well, that's not enough time. What if you could send it out on the day the product is done, and therefore they have a full 30 days to actually process your payment? Should you call and remind them? Some companies do interesting things. They print their invoices on pink paper. So in the stack of invoices that a billing person has to pay, they're going to see the pink one and maybe it gets paid first. I've had companies that send candy to the billing clerk because it's like a little bribe, like, hey, I love you. Here's some candy. Please make sure you pay me. These are simple things, but they actually work. So I'll be looking at reducing your receivables and how you can make that happen. But part of this is a plan. Hey, CEO, hey, leadership team, how quickly are we getting paid? And let's figure out a plan, what we can do to impact that. And that's the discussion and then decisions. There's an actual plan of attack. It's not just a hope or a prayer or not even, or ignorance, not knowing what it is. You need to know what it is, and then you need to talk about what you could do to impact it. And that's what you can do as a leader in a business. And most people are not working on these things or thinking about them enough. So stock days, that's inventory. How do you lower the inventory? So you could, make for having more money in the bank and less money sitting on the shelves. Now, some companies love having inventory on the shelves, but know that, it's money sitting on the shelves and it's in inventory, not in cash. This whole idea of just-in-time inventory, prior to COVID, I mean, there was such a huge deal. The goal is to be as lean and mean and just-in-time inventory and have just enough inventory to meet the needs of your business, no more, no less, because then, of course, more of the cash is sitting in your bank. That's ultimately a good thing. Well, what happened with COVID? Well, the supply chain got completely disrupted, and now that just-in-time inventory became a disaster because you didn't then have anything. And if you didn't have inventory, you couldn't sell, and it affected revenue. So now the school of thought shifts a little bit that, just in time has its place, but if you're too lean, it could also negatively affect you. So back to what I'm saying, this is all about making decisions, looking at all the information and knowing that there are consequences to those decisions. So you've got to make it and really think about, what the implications are and what that impacts in another place. All right, and then the last one here is creditor days, and that's payables. So when I talk about this one, it makes me a little uncomfortable because what I'm talking about here is, so you want everyone to pay you early or on time, but now I'm suggesting the people you owe, you might want to pay them a little late because again, you want the money in your bank account, not in your vendor's bank account. So, you want to get paid, but you got to slow pay someone else. So again, there's a balance. You want to be a good customer to your vendor, and if you slow pay them too much, then you won't be maybe a priority to them, or they won't give you a discount or some other things. So again, consequences. There's always a consequence to every decision, but you should be at least looking at all the pros and cons of what that decision is and making an educated, conscious decision on what you want to do, the strategy on how you want to impact your cash in a positive way for your business and know what makes sense. So on the balance sheet side, that's reducing receivables, increasing, reducing your inventory, and then increasing, your payables. All the big boys, some of the most successful, profitable companies out there, the Amazons, Meta, Walmart. If you talk to vendors that work with them, this comes to life a lot because they pay slow. Because they're the big guy, and you're like, well, if you want to do business with me, I'm going to pay you in 60 days. I'm going to pay you in 90 days. And you just have to learn to build your business around it because they want the money for them. So they've learned these tools and they're using them very effectively. It doesn't mean you can't too. You just got to be careful because you just don't have as much power as they do. But it doesn't mean those tools and resources and these levers cannot be used to your benefit. Okay, so that is the Power of One theoretical. Now I want to just take a second and show you a little bit of this in action. By the way, this is actually a software program that we use with our clients, and it is publicly available to purchase. It's called the Power of One. And so what you would do is, with putting in your own specific financials, then you could run these models with this very simple tool to kind of have these conversations. Now, you could easily do it on yourself with a basic spreadsheet and do some of these things, but this just makes it really easy. So in this business, let's look at it here. This business has a net cash flow of $843,433, and they have an operating profit of $2 million. So that's the current business. So now this business team is sitting down looking and saying, okay, how can we impact things? So what did this company do? They decided that the customer is very price sensitive and would not handle a price increase. So they decided to not spend any time increasing prices. Okay, that was their decision. I explained to you earlier why that might not be the best decision for you, and you really need to look at it, but they decided not to. So how much does that impact the cash flow? Nothing. How much does it impact the profit? Nothing. They're not changing it. It does nothing. So what did they do though? They wanted increased volume, 2%, just 2%. Does that seem like a lot? Could you most teams look at themselves and say, we could figure out how to increase our volume 2%. I would hope so. So this is a minor change in how you run your business. But look what it does. It impacts their cash flow, $51,000, and their profit, $264,000 in profit by just a 2% increase in the business. Now you'd say, wait, why is cash flow 51, but operating profit is 264? Well, that's because profit and cash is not always the same. When you increase your volume, it costs more to produce those goods. The cost of goods, your overhead, that's why for every dollar you increase volume, it doesn't go to cash. In this case, only 51,000 in cash versus, but it does increase the profit. And here you can see, woohoo, look, we've increased our profit 264,000. We're killing it. No, it only increased your cash 51, which is still great, don't get me wrong, but you can't then say volume increase puts all the money in the bank. Now remember, this one had 0 here for price. If it was reversed and we did a 2% price increase, then the cash and the profit would increase equally, and unless it decreased your customer base, but that would be different. So they increased it and see what happens there. Okay, they also did a 2% reduction in cost of goods. 2% reduction in cost of goods. Again, can I challenge you to challenge you and your team to figure out how you can reduce your cost of goods by just 2%? It doesn't seem like a huge lift. That's not a lot, but look what it does. Holy crap. If you reduce your cost of goods by 2%, it would add basically $1 million of cash into the bank. $1 million. That's huge, guys. So this is what the power of these conversations are, and that's why it's called the power of one. Look, 2%, $1 million. That's huge. So look and discuss, how can you reduce your cost of goods? Have a real conversation around it. You'd be surprised when you get a lot of smart heads around a problem, you can come up with solutions. So this is a great leadership team conversation, reducing your cost of goods and increasing your cash. And look, it impacts profit almost dollar for dollar. So that's great. And that's great. Great profit, great cash. Okay, so let's look at the next one. So a 1% reduction in overhead. So when business gets tough, the economy gets tough, you know, business is struggling a little bit, what's the one thing they go to do? We got to cut costs. Let's cut costs. And so they make a holistic cut of costs. And don't get me wrong, that could be a very effective way to, you know, stop the bleeding and keep more cash in the business. But also keep in mind that those are your resources to grow. And so again, consequences. So you got to make strategic decisions. If you cut too much, you then limit your ability to operate your business in a healthy way. And you might actually be, you know, stopping the bleeding, but ultimately killing the patient because you've now reduced your opportunity for growth, to grow out of the challenge and get to a healthy place again. And then you're in a death spiral down, not a growth spiral up. But in this case, we reduced overhead by 1%. And that affected cash by 112,000. And of course, every expense you reduce goes right to the bottom line. So that's a dollar for dollar, same amount in profit. Really awesome. And so those again are the ways you impacted the P&L. And you could see minor differences, 1%, 2%. Boy, what if you could do 3%, 5%? Sometimes there's a lot of low-hanging fruit, and you could have some huge impacts here. So you should really have these conversations and see what you can do. And this isn't a one and done, guys. Once you do this and you get the low-hanging fruit, you go 90 days, maybe 6 months, and then you have it again. Because probably what happens is once you've accomplished this and you've made some improvements, you've now learned and you've tightened things up. Now there's probably a second round of ways you can do things and have those same conversations, the same decisions. Can you take it to the next level and improve your cash and your profit? Okay, whoops, sorry. Back to this. So the last 3 here are on the balance sheet side. So here's what we did. Look, reduction in receivable days. That's getting you paid 2 days earlier. 2 days earlier. Does that sound like a lot? It does not to me. If you could impact 2 days earlier, $329,000 in cash flow impact. Now, if you get 2 days earlier, it doesn't affect your profitability, right? That money was coming to you anyway. You just got it faster and it had a huge impact on your business. You reduced your inventory days, the amount of inventory on hand, by 2 days worth, $257,000. In this case, they didn't change their payables at all. They felt like they were healthy with their paying, and they wanted to keep it the same way. But overall, look at the small amount of changes. Not one thing above 2%. They never raised prices. They never paid their vendors any slower, and they impacted their cash by $1.5 million a year. And they added $1 million of profit to their bottom line. Who would not want that for your business? And then what do you do with that money? It allows you to do lots of things. You could invest some of it in growth. You could take some of it off the table. You could invest in a new business. But that liquidity gives you the cash. The cash gives you the lifeblood, gives you the power to do all sorts of things. And now you're making decisions from a position of strength with cash in the bank. And I promise you from experience, you feel a lot better running a business with cash in the bank than always wondering how you're going to make payroll and keep the cash going. So revenue is vanity, profitability is sanity, but cash is king. Cash, cash, cash. Okay, that is explaining the 7 levers, and I hope that was really impactful for you. I want to point out that this is part of a whole series of webinars and workshops that Assured Strategy puts on. All the webinars are free, and the workshops just have a small fee, but they're full-day workshops that we really dive deep into some of these things. And it's just, we want to give back and support the business community and share what we learn with our own experiences and working with our clients. So please, on our website is where you can find all these events. And we do have our YouTube channel with all the videos. This video will be on our YouTube channel. So not only can you rewatch the one that you're on right now, but if you didn't know we had videos, you can go back and see some of the other great topics of webinars we've already had and see those. And again, I'm Warren Sager with Assured Strategy. And if I can help you in any way, help you grow and scale your business, myself and the rest of our coaching team is here for you. So I thank you. I hope this was impactful, and I definitely left a little time for questions. So if anyone has some, please post and we'll stay on a little longer. If not, again, thank you for attending and hope you had some takeaways and you do not do what I did, which was grow yourself right out of business. Cash is king. Thank you. All right, let's see if we got any questions here. All right, I'll give everyone a minute to think if they want to put one in the chat. Otherwise, we'll be good. Great. Well, thanks again, everyone, and you have a wonderful day. Bye-bye.